Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, we have a special guest today from Invesco, Brian Hartigan. He's the global head of ETFs and index investments. Why is Invesco so interesting?
Yeah, they're in the Terrordome they're in the upper echelon, but not in the big two. And so they're in that sort of like level with First Trust and Schwab and other sort of like, I'd say big dogs, but not quite Vanguard and BlackRock. And it's an interesting spot. If you look at their funds, they have a ton of hits. A lot of people, like a lot of ones people love and know. And it's
one big one.
One big one, yeah. One super stud, the Qs.
QQQ.
And QQQM.
Perhaps you've heard of it.
Yeah, perhaps you've heard of it. But it's an interesting company. Obviously, it used to be Power Shares, purchased by Invesco. And we have had a couple episodes where we talked to analysts and reporters. But this is sort of like, hey, let's wrap the year up talking to somebody who's in the Terrordome every day fighting for every dollar. It is hard in this industry. And there's a lot of things going on in their products. They have a diversified product line. So we can touch on a bunch of different themes here and just sort of get the perspective from inside that competitive hellscape.
Again, joining us, Brian Hartigan of Invesco. This time on Trillions, Invesco's ETF Playbook. Brian, welcome to Trillions.
Morning, guys. Great to be here.
Just so that we have a disclaimer, Invesco is a Bloomberg sponsor. Okay, so I want to talk to you about Invesco. What's the secret sauce at Invesco that strategically distinguishes you guys from all those other players in Eric's Terrordome?
Sure. Yeah, the Terrordome, I love it. It brings out some of the grittiness, but we've been in the game for quite some time, right? So we just recently hit $1 trillion in assets. Shameless plug, trillion. But it's through
I see what you did there.
Well, no, we always say the name we gave this podcast aged really well.
Yes.
Number go up. So trillion.
Trillion. Keep hitting the trillion flows. Invesco's been in the ETF market for quite some time. Early days, pioneer through Power Shares, expansion into factors, fixed income, commodities, and global in terms of our overall reach. So we've been in the Terrordome. We've been fighting, competing. We understand the landscape. And it takes that level of focus really to compete and reach investors within the ETF landscape. So it's been a testament of really understanding investors, understanding needs, and evolving as we've gone.
What about this year? What have you learned this year that is a timely insight for our listeners?
Sure. Yeah, it's been a great year of returns. Many folks kind of forget that first February, March sell-off, right? And what was interesting about the market correction is it really opened the door for more diversification from our view. There was a lot of U.S. equity dominance, and that was great for ourselves, for our lineup. But I think you started to see investors look at more opportunities for diversification. Factors, international commodities came back into play. So it's a new world for investors to look at how do they want to diversify through ETFs.
One of the things that was interesting to me, so if I look at your ETFs by flows this year, the QQQM and QQQ are at the top. So let's move those aside because I think everybody knows them. But number 2 is kind of a shocker, or 3 rather, is a shocker, Joel, SPMO. Most people probably don't know what that is. That's the Invesco S&P 500 Momentum ETF. You also have an international momentum in there. We call that smart beta. We used to have a bunch of episodes on smart beta. Kind of like went away because it's not like the hot topic anymore, but it took in, I don't know, 500 billion-ish this year. So smart beta, obviously, for those who don't know, is basically when you take an index and you tweak it a little, so instead of the S&P, you tweak it so it has a momentum tilt. And so it's active but passive at the same time. And that sort of smart beta is like 25% of the assets. People don't talk about it. It's still taking a bunch of cash. How would you obviously you're still talking about with clients. What are those conversations like, and how did this one particular ETF get so high on the list?
Sure. For us, smart beta is it's a mechanism of factors, right? What is explaining market returns? And when you look at it this year, concentration, Mag 7, those are all momentum names. So momentum clearly is driving returns and it's driving flows. The beauty of smart beta is that it's emotionless. So you don't have to say, hey, are these getting too big? Are they becoming too large in my portfolio? So that creates that forced discipline. And I think investors are showing that they want to know what the potential outcomes are going to be of the ETF.
So let's talk a little bit more about smart beta and how smart beta works, because it is unemotional, right? It's just detached from that. And it's got a little bot that basically tells it what to do, and it's going to rebalance at set periods of time. There's been some pretty noteworthy ones that Eric and I have discussed before, but I'm curious from your perspective, when was a moment in time that you were like, wow, that was exactly what smart beta is supposed to do?
Sure. Yeah, as you said, it's an index, right? And it's smart in that it is more than just buying the entire market. So it has a pre-programmed discipline to it that gets you to an exact factor. So for us, it's seeing some of the leadership change. So when we looked at our flows, as you do on the show, last year quality was one of our biggest in terms of garnering attention. Investors not sure where the market was going, and quality tends to take on kind of a best of breed. It's not your biggest momentum, it's not your cheapest, but it brings in fundamentals. And we saw much of that last year. Then you saw kind of the election change, sentiment change quite a bit in the market, and momentum took off, right? Mm-hmm. That was investors getting back into the market, and you saw leadership change. And that's what we tend to look at not only on flows, but also on market returns through factors.
Yeah, let me give you, this SPMO is up 27%. That's even better than the Qs. And it's way better than the S&P, which is 18%. Oh, that's a good year considering what you said about the negativity earlier. One thing about SPMO and momentum is what we found, Joel. We looked at active funds. A lot of active managers this year, they did that thing where they are all full of the CFA, like fundamentals. And I get it. And they shifted into like non-tech names. Momentum, meanwhile, saw that tech names were actually going better and tried to ride that, and it worked. So not having the Mag 7 is what caused more active to underperform this year. They keep taking the bait of biting on these like other more fundamentally sound or lower valuation sectors, and they're like, tech is just too expensive, and ends up tech just goes up again.
But this is kind of where smart beta is distinguished, right? Because it can just look at it from the numbers and just be like,
absolutely,
we know exactly what to do now.
Except like a value ETF that they have probably didn't perform as well, but it's just doing what the robot says. But momentum obviously went into the tech names, and the rest is, that's why it's number 3 on the list. So obviously those factors, there's regimes, right? Yeah.
Yeah, so the regimes, and I think, Eric, you said it best, right? It creates a challenge in the market, not only for active, but for managers, right? Where do I allocate? Because you have such a systematic bias towards price returns, momentum, size, and exposure, right? So the momentum factor creates a bit of a decision for investors. Is it going to revert, or do I want to continue to maintain the trend? And we're seeing people really use this as an allocation, right, to hedge some of those decisions.
So why does this space get talked about less now than, say, 10 years ago, when it was a little spicier, I think, but yet, active is sort of having a moment. So why isn't smart beta a little bit more part of the conversation?
Yeah, I've lived through quite a bit of it, and you have written about it. The active passive debate, right? Smart beta was trying not to be just cheap and market exposure, right? It was smarter, it was differentiated, and in every way it was active. We talk about our S&P equal weight fund, RSP. It is one of the highest active shares that you can get compared to the S&P 500, right? Active means trying to be different than the index so that you generate differentiated returns. So it was kind of caught up in this, what are ETFs, passive, active, and now active is having its new moment in its term. But the definition of active is really evolving, right? It's not just stock picking anymore. It's outcome-based. It's active allocation. It's smart beta. It's factors. And it's investors saying, I want active. I value the opportunities in active, but there are so many different ways by which I can outperform, be it manager or very pinpointed exposure that I can get through fixed income, equity, and even asset classes, right? Themes and the like.
I would say RSP, their equal weighted one, is the one I get asked a lot about, especially the Money Show. I go to the Money Show. That's like direct retail investors. They always ask me about equal weighting. People are fascinated by equal weighting. It almost seems like more fair. Like, yeah, I would like some of the stocks that are a little less loved, but it doesn't always work. But clearly, as someone who has a product, if you do want that, like, I want the market but with a little less Mag 7, this one seems to be the first thing people reach for when they want that, versus, say, going full value or some of these new products which are like, hey, let me give you the S&P minus the top 100. They're getting really very specific. But I think equal weight, it sort of like covers that feeling of like, yeah, I want the market but not with the Mag 7 like dominating. $75 billion is the equal weight. But can I ask you a story about this? Goldman filed for an equal weighted ETF back like 10 years ago. And this one was 40 bips. And before Goldman can even make it to market, they cut to 20 and just killed Goldman right there and ended up just taking all the money. And that said, that's why I call the Terrordome, Joel. They looked at the Goldman coming. There's like, okay, we have to sever our own arm to survive, right? This is like Castaway, okay? They did it, and they more than made up for it in dollars since then. But I don't know if you were part of that decision, but can you go through that mentality? Because if you're from the mutual fund world, that's nothing even close to that exists. If anything, you just start charging more.
Brian, did you look at your arm and say, I don't need that anymore?
Well, depending on how much we broadcast on this one for the show, it actually happened. I'll give you something of a nugget. The price cut was actually just prior to the acquisition of Invesco to Guggenheim. So certainly the numbers were recognized in the final deal terms. So for us, competitive pricing gave us an opportunity. But equal weight, maybe I'll pivot to some comments on that. So equal weight for us, right? It's understandable. It's S&P 500 equal weight. It's predictable. Investors know that when the Mag 7's not performing, being underweight, those names are going to likely generate outperformance. So one of the downfalls or challenges that active has is unpredictability. Investors don't want to be surprised by active. They don't want to get a different return than what they expected. So last year, if you look at our flows, we had this dichotomy of QQQ, which is concentrated, large names, being one of our leaders, but RSP also being one of the leaders in terms of flows. And that just told us that investors are trying to understand where the market's going to pivot. And if it goes one way, it continues to run, QQQ will outperform. And if it goes another way, and reverts, then something like RSP will have different bets. So that's the understanding, and the market is getting more sophisticated, that they want some predictability in where they allocate.
Do you think the Terrordome has gotten more intimidating?
The Terrordome is pretty full with, is it roller skaters, or is that a different...
No, by the way, the metaphor, people do throw in Thunderdome.
Thunderdome, yeah.
Now, that's Mad Max Beyond Thunderdome. That was the third Mad Max movie, I believe, where Tina Turner did this theme song, whatever. We don't need another hero. That's Thunderdome. It works. Terrordome is based on a Public Enemy song called Welcome to the Terrordome, a whole album, in fact. Listen to it. In my opinion, that sound and the lyrics are what it would feel like if you launched an ETF.
Mm-hmm.
So I have my playlist on the way out. I
would say, you got to add that one.
Yes, for sure.
Yeah,
and a big Public Enemy fan.
They should play it when you walk into the office at every issuer. It's like the frame of mind you got to get into. It's total survival.
Office space, like today was a good day. It's like,
yes.
It's Terrordome. Okay.
But competition is certainly increasing, right? The active passive mutual fund ETF, I will say ETFs are clearly becoming or have become the wrapper of choice. And the competition is trying to understand how can they compete in that game. And it makes it very difficult for new entrants, makes it difficult for legacy large providers trying to pivot not only the wrapper, but their active content. And there's a whole ecosystem from capital markets to product innovation through index provider relationships and the like that really make a strong ETF what it is. And that's through that knowledge of investors and opportunities that you can create that outcome.
The big three in ETFs, which would be Vanguard, BlackRock, and State Street, their market share is eroding because there's so many competitors. I think 60 new issuers this year, 300 total, 600 brands. There's just too many people nibbling at their market share for them to grow it. However, in the mutual fund space, their big three growing market share by a lot because there's just no energy. There's no hungry newcomers. And I think that's what makes the ETF industry so dynamic and endlessly interesting for us, obviously. But one thing on this, there's been a couple, I'll call them like chirping Every year or so, somebody writes something about how ETFs are ruining the market. Lately, it was how they're ruining capitalism. And I just want to say, I find that ETFs are probably a shining example of capitalism because it's so brutal. It's very competitive. In the end, the customers are choosing. It's natural. There's no kickbacks. The best products win. And would you argue that, or is there something we're missing about how there is potentially a problem in terms of ETFs? I know part of that argument isn't the industry itself, although it's about the number of ETFs, although there's way more mutual funds still. But it's also about fundamentals and if all this money's going into passive, fundamentals don't matter anymore. I don't know. You have anything about all that? Because once a year, this stuff comes up. I call it the Some Worry articles, and a few of them just came up over the past week.
Sure. Yeah, so I would agree. There are pockets of opportunity when you look at the ETF ecosystem, right? So capitalism as a whole, if there's an opportunity for gain, if you can set up a system to generate profits, that will create that outcome for you. There's no excess limit, or there's no limitless. There's no limitless capital in the market. So I think what you've seen is a bit of a shift of where some of that liquidity has come from, and it's driving towards the ETF. The ETF creates more liquidity. You've seen it in digital coin, right? Very simple wrapper, but it's creating liquidity. It's creating a different way to access an otherwise liquid market. You see it in options. The outcome of all of these buffer and option income advantage strategies are creating more liquidity in the underlying and fixed income, right? Fixed income used to be a trade by appointment type of market, and ETFs have created better liquidity in the underlying. So it's not a guarantee, but I think through that ecosystem of trading, of market making, you're getting better pricing and better liquidity within the wrapper and within the markets.
Is there a version of the world that becomes too liquid? That was some of the worry.
Sure, and I think there's value in private markets, private credit that create solid access to issuers, differentiated return streams that the market is looking for. Will ETFs become the save all for private markets, private equity? Not sure. I struggle with the point we touched on of liquidity and transparency is what an ETF thrives on. And I think you're trying to create something different with private markets. So having that difference, I think, is important because you're going to get different return profiles from those two.
You mentioned digital coins. You have a Bitcoin ETF, BTCO, I believe is the ticker. You were one of the original 10 who launched about 2 years ago. Huge deal. They got to $150 billion in assets total. Since this sell-off, this has been the worst. There's been a couple pullbacks, but this is the worst one. I think at the peak it was 40% down from the peak. I think it's 30, but it was pretty bad. Now, only 4% of the assets left. The flows were pretty solid. As the crypto Twitter crowd calls anybody investing in ETF as a boomer, apparently. The boomers have stronger hands, I think, than people thought. But I want to talk about from your perspective. This is a different asset class. It's new. It's we call it hot sauce. How are these investors that you have thinking about it? Are they talking about it? Have they committed to a 4 or 5 year holding period and they don't care? What's going through their minds, and what do you make behind them holding up stronger than most people thought?
Sure. Yeah, I think I touched on the evolution and how ETFs can help create accessibility to new asset classes like digital and others. For us, this is a long game. This is how do I access it? How do I model it? How do I own it in a portfolio? And we're seeing that with clients too, from wealth channels among advisors, right? There's limitations on how or where they can allocate. So I think the due diligence process has taken some time to get that into a variety of outlets for investors. So definitely a long game. I think you're seeing some short-term technicals, which shows you that it's behaving like an asset. There are investors that might have gotten in late and are now sitting on losses that they don't have elsewhere, whether it's equities or other asset classes. So you have some short-term sell-offs, maybe tax loss that investors are taking. But I think having kind of this evolution into what we would all know in terms of kind of technical markets, you're starting to see that within the asset class.
what do you think their appetite for a risk asset like this is? Because, down 40%, down 30%, like it's asking a lot of a boomer specifically to hang in there, right? Like how like what's the appetite, the real appetite to take a loss or write it?
Yeah, the key is education, right? How much did you allocate and why? Was it a cocktail party discussion, or was it true fundamental asset allocation that you said, look, this is new, it's volatile, I should own it in a certain percentage, that is either market cap weighted, benchmark weighted. But if you're over allocated and you see this volatility, people should understand what those risks are going to lead to, right?
We looked. I just finished a book project on this. We looked into this. If you held Bitcoin for 4 years, at any time of its life, you made money. If you had a 4-year holding period, but once you get below 4 years, it's up in the air. You might have made a lot of money or lost a lot of money. So it seems like a 4-year holding period would be like if you can't commit to 4 years, don't buy it. That would be my advice. The other thing is we have this thing called a modern portfolio where we have found that a lot of portfolios have gone to the core is, low cost, probably cheap beta or cheap smart beta or even cheap active. But it's like that's the vanilla stocks and bonds. Usually now that's below 20 bips. But then that's boring, right? You got to wait 30 years for compounding. So people want some fun and speculation. So we call it the hot sauce bucket. It seems like if you put some of this in your hot sauce bucket at 2-3%, then if it goes down, it's not the end of the world because it's not really your nest egg. And so there might be more intestinal fortitude you can get because it's only a little tiny part and it's not your nest egg. That's my thesis on how this ETF thing has lowered fees and made it very easy, and education is there that it's like, oh, I can marry this low cost ETF like PBUS, which is like cheap beta, and I can just wait 30 years while it compounds, and then I can do this other stuff. And the fact is people can get real committed to a portfolio now. Versus back in the 80s when you had a 5-star manager, they charged a lot, then they underperformed, then you had to dump them, and you just dumped them at the bottom. Then you got the next one after they had already had their good run. So people were constantly buying high and selling low. I feel as though ETFs and low-cost investing in particular have in a way solved behavior and allowed not only for holding long-term vanilla, but even having more stomach for the hot sauce because it's only a tiny part of the whole meal. Does that make sense? Am I onto something there, or just am I losing it?
No, I'm right with you. I think I would shake that into kind of this evolution of creating active or putting active decisions further down the advice chain, right? It's not just the manager, it's the advisor, it's the investor, and the ETF is creating more liquid, more accessible tools for you to express those active bets, whether it's new emerging asset classes or even fixed income, right? Fixed income, you have pretty good success on the active side of active managers, somewhere above 50% on a near-term basis. But investors now have the ability to overweight or underweight duration. They could overweight or underweight credit. They can take a core, like an aggregate type strategy, and they can play around the edges. And that's what the ETF does. And through the underlying, gives you better execution, better liquidity, better pricing to sourcing those exposures.
But how do you feel about Eric's hot sauce metaphor?
I've always loved the hot sauce, and we always want to get more tickers in the hot sauce category.
Yeah.
Exactly.
That's why I roll with it. I've gotten pretty good feedback on it. I also think you can't mess with it. Everybody knows what hot sauce is. Everybody knows it's used in small doses. Not everybody loves it. It just it's solid, Joel. Sorry.
As you just said, though, love more tickers in the hot sauce category. Is that where the white space is? And how do you distinguish yourself in that hot sauce category?
Sure. I let Eric stick with the hot sauce, but for us, it's emerging trends, right? So
no, they have hot sauce.
We have lots of hot
admit
sauce.
It. Tan is hot sauce. I'm sorry. It's 20 solar stocks. I'm sorry. That's going to move 2-3x the S&P. Thematic is hot sauce.
So,
it's mild hot sauce. It's not like ghost pepper, but it's still hot sauce.
So I totally agree. Hot sauce had been thematic, right? First to market, new ideas, AI, for us, blockchain, technology, even banks recently have been, call it hot sauce or emerging trends. And we've seen that, again, investors not looking at thematic to get in and run returns, but starting to allocate and using thematic as ways to differentiate their portfolios, ways to generate active returns because you've got some of that differentiated profile. So thematic, which used to be, hey, let's be first to market, let's raise the biggest ETF, has started to compete to, again, a more mature market where investors are using it for hot sauce, Eric, or for outsized returns.
By the way, fun fact here? I believe PowerShares started the first thematic ETF ever. Can you name it? You might not know. This is going way back before Invesco even acquired them.
If I grab a drink of water, would I be right?
Yes.
Ooh, wow.
Water. It came out in like 2005 or something.
What's the ticker?
Get this. It's PHO. But they should have, the Vietnam ETF should trade you. You should be just HO or something and give FO to them. Anyway, that's just something that I always thought.
We evolved to numbers, H2O at some point?
Yeah, that's it. That would be perfect.
an easy one.
But the water ETF, this has $2 billion.
Wow.
You know why? Because
Been there for
at some point, Joel, water is going to be a big deal. Hopefully it's after we're gone. They're going to be fighting wars over water. This thing could go to the moon, but it's just that when.
It's like The Graduate. I've got one word for you. Only it's not plastic. It's water.
It's water.
It's water.
Well, that's what they call it, blue gold.
Yeah.
I did a lot of research on water. I thought, oh my God, this is the big thing. I wrote all these articles, and it's like, you could get that. This is one of those calls you can get right, but be like 50 years early. Remember, the movie Waterworld? That's what that was kind of all about.
Okay.
Anyway, we could have water could be the best performing ETF in history at some point in the future. We just don't know when.
I could say that about a few other things probably, but I like your enthusiasm.
Yeah.
Okay, so one thing that we've touched on, but we haven't actually really spent some time talking about it yet, is an ETF that probably needs no introduction, but the Qs. Eric calls it the eighth wonder of the world.
Yes.
Has it gone up at all? Can it be like seventh or sixth yet, or does it have to be eight still?
Well, there's seven.
I know.
Yeah. Come on. You definitely know that. Okay. The reason we call it that is also because it's like an unusual specimen. Like typically you have an index and it's market cap weighted, and it's like, okay, that's beta. Beta does really well. Then you have like the tech sector. Okay, great. Tech is good. Qs is neither one of those. It's just stocks that list on NASDAQ. So it's like, what's so great about that? Well, I pondered this more than a normal person should. My thesis on the why
kind of
Qs,
your job, actually.
Yeah, it is my job. But I went real deep. My thesis on why the Qs kick so much butt, and it's not tech and it's not beta, and it's just these stocks that list on NASDAQ, is the Steve Jobs effect. When Steve Jobs in 1980 called you guys, I asked your PR person, Stephanie, if I could even find the person who took this call, but they said they're probably retired at this point, or even worse. But in 1980, somebody took a call from Steve Jobs. He said, I want to list on NASDAQ. And they were like, sure. And Apple, nobody knew who Apple. Steve Jobs was 27 years old. And he wanted to list there because all the dorks from IBM were on NYSE. So he wanted to go to NASDAQ, just like Michael Jordan went to Nike instead of Converse and Adidas. This was the Jordan-Nike moment of this market. Once Steve Jobs went there, people were like, ooh, that must be the place to be. So, of course, Bill Gates, who worshipped Steve Jobs, he went there when Microsoft went public in 93. Then you got those two guys there. It's over. Since then, especially when Steve Jobs came back for his third act, that has been the place to be. Amazon, Tesla. If you are a visionary founder, CEO who works 7 days a week, that's where you go. Steve Jobs set that. He was the mold of this tech revolution. And to me, that's why the Qs kick so much butt. It's the Steve Jobs sort of effect. Thoughts?
Fully agree. The NASDAQ 100, as we've talked about smart beta, it is an index, but for us, we track it based on innovation, and innovation as a factor that we track is on R&D, research and development. And if you looked at those 100 names, each of those companies commit more to research and development than any other peer group. So it's founded in innovation, it's founded in differentiation, and I think going back to original days of Apple to Microsoft to what we see today, it's truly evolved with the modernizing economy, right? So going from PCs to servers, to telecom bandwidth, to having a PC in your hand that's mobile, and getting into AI that you speak to on your phone. For 25 years, it's evolved with not only personal consumption, but the evolution of our modern economy. And the leaders that are driving that tend to be listed on NASDAQ.
Can you pull some strings and get us this person who took the call in 1980? If we can get them, Joel said he will do a whole podcast, Ken Burns type documentary on this. But we need that person. Can you pull some strings for me?
We'll do some digging. Yeah,
I mean,
sure.
Yeah.
Or reach out if you're
like,
listening.
did they know the importance of that call?
No, I'm guessing not. I think it's just another phone call where you're like, yeah, sure, whatever, and then everything else that follows, you're like, oh, I'm a
love
genius.
that stuff, though.
We'd love to find and interview that person. As long as we're talking about Qs, probably can't talk about that without talking about the Unit Investment Trust, the UIT, which is basically the framework that QQQ is built on, and not that many others, like one.
That's right.
If you could have a redo, is there anything more in your life that you would rather have a redo on than Q being a UIT?
Sure. Well, of course, you want the ETF market to be started, right? So thank you for the pioneers in that regard. But like many things, markets evolve, structures evolve, regulations evolve. And we've seen that throughout the last 25 years in the ETF market to get to some level of standardization. There was a time at which some had exemptive relief and some didn't. So early entrants that had that relief were able to launch ETFs, others were not. So evolution is great. And that's an opportunity for some of these unit investment trusts to modernize their structure, and bring the structure and the ETF ecosystem into that investor base.
So our outlook, which we published this month, basically is ETFs are living the dream, but reality checks await. So we don't think this big movement's going to be dampered much. Market going down a little, maybe it's like a little less record-breaking. But there's a couple things out there. Like, for example, some stocks are real volatile and they get 2x'd. And one of those probably will blow up. There could be something there. The mutual fund share classes that are adding ETF share classes, there could be some tax contagion there where the ETF gets capital gains because of the mutual fund. There's a couple things that I think are maybe possible stories. Also, just the paradox of choice. So many products that it's just hard to pick.
I call it the bread aisle.
The bread aisle.
What am I going to do?
Yeah.
Which type of bread am I going to use?
So many sourdough.
So those are some of the things we're looking at as like what could be some hiccups. We don't see anything derailing it, but what do you make of that? Like, what keeps you up at night? What are you looking at, whether it's your own firm or the industry as a whole?
Sure. I think ETF share class is a great opportunity to integrate structures and bring some of the advantages that ETFs offer into mutual funds. But I've been out there saying that there's pure and less pure, right? So an ETF that only has its own, not share class, but trades as an ETF will take advantages of all the taxability, all the liquidity, the track record, and the like. Pivoting into the share class is complex, and that's why you've seen some of the reviews, the industry come together to identify what the solution is and what would look like a preferred outcome for investors. And there's still quite a bit of uncertainty there from not only wealth channels, but issuers as well, because you have to be transparent. Some managers don't want to be transparent. We've seen that. We've tried that in non-transparent. The market didn't really respond to it. You have to have the right pricing. You don't have to be the lowest cost, but there could be price impacts. So you need to look at economics and the impact of that overall. And you still need to provide returns. Just moving it into an ETF doesn't guarantee success. So differentiated, active, strong managers, quality investment performance is still going to drive the day.
Yeah, you got to toughen up. I always say you have to come to the ETF industry on its terms, not yours. And not everybody wants to do that. That said, we did the math. There's about 3,000 mutual funds that currently don't have any ETF, where the issuer has no ETFs at all, that have filed for the share class. So there's potentially 3,000 new ETFs that could just be bolted on to a mutual fund. Probably won't be that many. That's a big deal, Joel. I mean, it just might take a couple of years to play out, though.
How much of 2026 are we going to be talking about this?
A lot. I think DFA is going to be the guinea pig. They're really pushing it. It fits their whole business and plumbing perfectly, this particular thing. But if they see success, look out. Especially, it's tricky. There's one caveat to all this, and I'm not sure if you thought about this, but Capital Group, they were on ETF IQ. They said, we're not doing anything. We don't believe in this. And they're the biggest active manager on earth. I mean, they're the number one. So what they say matters. And if they looked at this and said, we're just going to put ETFs out that are separate from the mutual fund, that's also Capital Group's why non-transparent active, I think, didn't take off. Because when they finally came in, they went transparent. And so that's also interesting. So I don't know, but all I know is if a couple people find success, the rest will rush in. But the first part is we don't totally know.
What does success look like, Brian?
So I think success is bringing more quality investment capabilities to investors through the optimal wrapper. And that's what we're looking at. We're on a very focused pace in our own path of share class, and that's looking at it very opportunistically, not ETF share class for all type of approach, but bringing where it makes sense, where we think we can have the liquidity, and where the managers can operate within the structure. So I think you're going to see, and each manager has a different strategy, right? They have a different path, and they've come down a different road. Some have large active, and they might say, hey, we're just going to cannibalize ourselves. We're going to try to get pivots into somewhat similar but differentiated strategies, not cloned, and that's our best path forward to avoid maybe a difficult decision. Others just want to get into the ETF space, right? So they want to launch and find a way to get into that market, but not all will succeed because there are, again, I'll speak to the ecosystem. There are trading implications, cost implications, liquidity implications that managers need to weigh.
Terrordome.
And another thing is the transparency thing is a big deal for some because they spend their whole life picking these stocks and they feel like it's their IP. But I have found that I don't think anybody cares. I mean, I give ARK a lot of credit. They came out transparent. She even shows you what the trades were that day. I mean, it's full transparency. And I just think that's sort of what people demand in their ETFs. It's sort of like an attribute of an ETF they're used to, so they don't want it to be different. But some managers just, I think it's hard for them to get over that. But I think they should. Nobody cares. Nobody cares if you have Amazon at 3% and the market has, like the S&P's at like 6%. Like nobody cares. It's like they're just going to look at the returns. So I just think it doesn't matter anymore. There's so many portfolios. Back in the day, it was like Jeff Finnick managed the Fidelity Magellan, and it was like that was like so big. And if he showed his holdings, you could get ahead of it. Like there was some legit issues. I don't really see that. Those days are over. So I think they should just come in, try it. This is the technology. Everybody wants to use it. It's the equivalent of Spotify. It'd be like being in a band and like refusing to take your music from compact disc and putting it on Spotify. Like, why would you do that?
Still some people that do it.
I know. Well, no, like Neil Young is like, listen to my music on analog. Yeah. It's like, okay, fine. Harvest Moon sounds 2% better on analog. But like, I'm sorry.
More than 2%. But I hear you.
By the way, Harvest is the better album. That's the one from 1973 with Old Man. That's a good album. And it does sound good on vinyl.
All right, Brian, final question. Favorite ticker other than any of Invesco's?
Wow.
Take your time.
I need a 10-second countdown.
Yeah, no worry. Take your time. It's hard. It's hard.
I'll motion with my hand to just like pretend that it's a shot clock.
Well, you like the ref when the guy's putting the ball over?
Exactly. It's like we're at 5 seconds, you know.
I'm going to bring it back to Invesco, but it's your favorite too.
What?
So most creative ticker. I can't give too much credit outside of our own home cooking. PBJ.
Wait a second. That's your ticker.
Right.
Oh, favorite other than yours.
Yeah.
I know. I pivoted.
He can't do it. So PBJ.
Matt Kaufman, who's from Wheaton, which is where the Power Shares people grew up, he picked PBJ, which I thought it was a good one. But
I'll give it to you if you can answer. Do you prefer the crunchy or the creamy version of peanut butter?
You always got to go creamy.
Yeah, that's how I am.
Crunchy is interesting. The real question is strawberry or grape,
Ooh, yeah, okay.
And then jelly or jam. So many decisions. Yeah, maybe there's an analyst here.
Yeah, PBJ, just wrap it up in it.
Or that stuff that comes where you press it and both come out at the same time.
That's gross.
Not for me.
Okay.
I'm fine with that.
Right. Well, that's the beauty of an ETF.
I have another thing. When you get the jelly and the peanut butter, do you use two different knives or do you Like, how do you deal with that?
Peanut butter first. Take the peanut butter all the way off on the bread, and then you do the jam.
You cannot possibly get all the peanut butter off without breaking the bread.
You can watch me.
Okay.
I'll give you a tutorial.
That's what that thing solves, is having to use 2 knives. It's annoying, but because I do eat peanut butter and jelly like probably once a week, and I wash the whole knife off, and I'm like, wow. That's for the guy who came up with that one where you pour both together. That's what he was.
There's a paper towel that you can also do.
But by the way, this is
the cutting room floor for this episode is going to be legendary.
Well, there is a metaphor there, which sometimes ETFs make like the 2x ETFs. They make something just a little bit easier, and that's sort of similar. Like, because we always tell people, like, why is this so popular? I'm like, honestly, dude, people are lazy. If you can make something just a touch easier, like, you're gonna get some buyers. Yeah. You know who said that?
Uncrustables?
And Dorsey Wright, Tom Dorsey. He was talking about how.
Way to bring it back to smart beta.
Yeah, Tom Dorsey from my book. He was like, he really highlighted the convenience aspect of ETFs big time. He's great. He's got a whole following. Yeah, he's part of their stable.
Yeah.
Brian, thanks for joining us in Trillions.
Thanks, guys.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. Trillions is produced by Magnus Henriksen and Ryan Kessler. Amy Keene is our executive producer. Sage Bauman is the head of Bloomberg Podcasts. Bye.